Good day, investors. In this video, we will take a closer look at Whitecap Resources, ticker symbol WCP. This Canadian oil company is quietly becoming one of the largest producers in the country, while still paying investors a strong dividend. After a major merger and strong operational performance, Whitecap has scaled into a top-tier Canadian energy producer, generating billions in cash flow while returning a large portion of that money to shareholders. In this video, we will look at Whitecap's production growth, the company's massive resource base, its dividend and shareholder returns, and whether the stock looks attractive at the current valuation. But before we get into it, remember to leave a like for the YouTube algorithm and subscribe to the channel for more upcoming videos. Thank you very much. So first, let's briefly look at the company itself. Whitecap Resources is a Canadian oil and gas producer focused primarily on light oil and natural gas production. The company operates mainly in Alberta and Saskatchewan, which are two of the most important energy-producing regions in Canada. Over the years, Whitecap has grown significantly through both organic development and acquisitions, and today, the company has become one of the larger oil and gas producers in the country. Today, the company has a market capitalization of roughly $17 billion and an enterprise value of around $20 billion. Whitecap expects to produce about 372,500 barrels of oil equivalent per day in 2026, which makes it the seventh largest oil and gas producer in Canada and also the fifth largest natural gas producer in the country. At current commodity prices, the company expects to generate around $3.5 billion in funds flow this year. To maintain and grow production, management plans to invest about $2.05 billion in capital expenditures in 2026. The company currently has about $3.4 billion in net debt, which results in a net debt to funds flow ratio of roughly 1 times. That is considered very conservative for an oil and gas producer, and it gives the company flexibility during commodity price cycles. And finally, Whitecap currently pays an annual dividend of about 73 cents per share, which is distributed monthly to shareholders, making Whitecap stock an attractive choice for dividend-focused investors. The company had a record year for production in 2025, as total output reached around 307,000 barrels of oil equivalent per day, driven by strong performance across its core assets. Another important development was the successful integration of the Dividend assets. The merger appears to be delivering strong results, with expected synergies increasing to around $300 million, significantly higher than the original estimate of about $210 million. As a result of the merger, Whitecap now benefits from greater scale, a deeper drilling inventory, and improved long-term sustainability. Whitecap also has a very large reserve base, which provides strong long-term production visibility. According to the company's 2025 reserve report, Whitecap now has around 2.2 billion barrels of oil equivalent in proved and probable reserves. These reserves provide the company with a reserve life index of more than 16 years, which means Whitecap has a very long runway of future production. The company also reported very strong reserve replacement, with production replacement ratios of 383% for proved developed producing reserves, 687% for proved reserves, and more than 1,000% for proved plus probable reserves. This means the company added significantly more reserves than it produced during the year, further strengthening its long-term resource base. And importantly, Whitecap continues to maintain a low-cost structure, with 2P finding and development costs of about $17 per barrel of oil equivalent, and 2P finding, development, and acquisition costs of around $15.8 per barrel. These low development costs support strong capital efficiency and profitability across the company's asset portfolio. The company's asset portfolio is well diversified. Whitecap operates a multi-basin portfolio across Alberta and Saskatchewan, which allows the company to benefit from multiple oil and gas producing regions. In addition, Whitecap has a very deep drilling inventory, with roughly 10,500 potential drilling locations across its asset base. About 55% of these locations are conventional assets, which typically offer high netbacks and lower decline rates, while roughly 45% are unconventional assets, which provide large resource potential and long-term growth opportunities. This diversified mix of assets also gives Whitecap significant flexibility in how it allocates capital across its portfolio. Because of this diversified asset base, the company can allocate capital to the highest return projects depending on commodity prices. As we can see on this chart, Whitecap operates across multiple plays, including Bakken, Viking, Cardium, Duvernay, and several Montney assets. Some of these assets are oil-heavy, while others are more natural gas-focused. Because of this diversification, Whitecap can shift its investment toward the projects with the best economics at any given time, depending on oil and natural gas prices. This flexibility helps the company maximize returns and maintain strong capital efficiency across commodity cycles. Now, when looking at Whitecap's crude oil price exposure, we can see that the company has a very attractive production mix. Approximately 88% of Whitecap's production is exposed to light oil and condensate pricing, which typically receives stronger pricing compared to heavier crude grades. About 63% of production comes from light oil, while 25% comes from condensate, leaving only 12% from medium oil. Because of this production mix, Whitecap benefits from strong pricing exposure and higher netbacks compared to many other Canadian producers. On the natural gas side, Whitecap is also working to diversify its pricing exposure in order to reduce market risk. Historically, much of the company's gas production has been priced at the AECO benchmark in Canada, but management is now expanding exposure to other global pricing hubs. For example, Whitecap has signed long-term agreements that provide exposure to European TTF pricing and US Henry Hub pricing. One example is a 10-year agreement with Centrica covering about 50,000 million British thermal units per day linked to European TTF prices, along with additional agreements covering roughly 35,000 million British thermal units per day tied to Henry Hub pricing. By diversifying its natural gas pricing exposure across Canada, the United States, and global LNG markets, Whitecap aims to reduce price volatility and improve long-term revenue stability. In addition to diversifying pricing exposure, the company also actively manages commodity risk through hedging strategies. For oil production, Whitecap has hedged roughly 26% of its production in the first half of 2026 and about 24% in the second half of 2026, with floor prices of around $85 per barrel. Looking further ahead, around 12% of production is hedged for 2027, providing additional protection if oil prices decline. On the natural gas side, the company has hedged about 30% of production in the first half of this year and roughly 28% in the second half of the year, with floor prices around $3.7 to $3.8 per gigajoule. These hedging strategies improve the company's risk profile and help support the dividend through commodity cycles. Another factor that strengthens Whitecap's financial stability is its strong balance sheet and solid credit profile. The company maintains an investment-grade BBB credit rating and benefits from a low cost of debt of around 4%. Whitecap also targets a net debt to funds flow ratio of about 1 times or less, which is considered very conservative for an oil and gas producer and further reduces the company's risk profile. In addition, the company has roughly $1.5 billion in available liquidity, providing strong financial flexibility. At the same time, the company's management team has delivered consistent growth over the years. Over the past decade, Whitecap has achieved roughly 11% compound annual growth per share in funds flow, production, and reserves. This growth has been driven by a combination of organic development and strategic acquisitions, allowing the company to steadily expand its asset base while maintaining strong capital discipline. Overall, this track record has proven Whitecap's ability to execute its strategy and consistently create value for shareholders. And importantly, a large portion of that value is returned directly to investors. Over the years, Whitecap has built a strong track record of returning capital through both dividends and share repurchases. Since 2013, the company has paid roughly $3 billion in dividends, which equals about $6.24 per share. In addition, Whitecap has completed around $935 million in share buybacks since 2017. Altogether, this represents more than $7 per share returned to shareholders, making Whitecap an attractive option for dividend-focused investors. So the big question for investors is whether Whitecap stock is attractive at the current valuation. At the moment, the company is trading at around $14.30 per share, giving it a market capitalization of roughly $17 billion. Looking at the valuation metrics, the stock is trading at a price-to-earnings ratio of about 14 times earnings, which is relatively reasonable for a large Canadian oil producer with strong cash flow generation. At the same time, investors receive a dividend of about 73 cents per share, which translates to a dividend yield of roughly 5%. So overall, Whitecap offers investors a combination of income, solid fundamentals, and exposure to the oil and gas sector. So in my opinion, Whitecap Resources offers a very attractive combination of income, financial strength, and long-term production growth. The company has a large and diversified asset base, a strong balance sheet, and a management team with a proven track record of execution. At the same time, investors benefit from a solid dividend yield of around 5%, supported by strong cash flow and disciplined capital allocation. Whitecap also maintains conservative leverage and an investment-grade credit profile, which gives the company flexibility during commodity price cycles. Of course, like any oil and gas investment, the stock will always be influenced by fluctuations in oil and natural gas prices. However, the company operates in Canada, which is considered a politically stable and well-established energy jurisdiction, helping reduce geopolitical risk for investors. Overall, I personally consider Whitecap to be a strong long-term holding, and it is a stock I would be comfortable continuing to accumulate over time. If you found this video helpful, remember to leave a like for the YouTube algorithm and subscribe to the channel for more upcoming videos. And as always, remember to do your own due diligence before making any investment decisions. Thank you for watching, and happy investing.